Hi, good morning from Cape Town, South Africa again. My name's Fred van Niekerk. Can you join us on our third installment of our educational-based webinars for Carrick clients and prospective clients across Africa? Unbelievably, we're on the second last day of the first quarter of the year already. Certainly is flying by. I remember discussing these webinars with a number of our product providers, not least of all my colleague and friend Richard Williams, who joined us today from Continental Financial Services, and how we were looking forward to presenting to our clients and prospective clients today. But thinking in January, well, it's so far into the year, I'm sure we'll have a lot of time to prepare for that. And incredibly, here we are. Hey, the year's flying by. Richard, I've really been looking forward to this one. I know that my advisors across our offices in Mauritius, specifically Zimbabwe, Malawi, and Zambia, have had huge anticipation for today's attendance. We've got an extraordinary amount of interest in this topic, and I'm rather pleased to say that we have fantastic attendance today's webinar. Again, people joining us from Nigeria, Malawi, Mauritius, Rwanda, Tanzania, Kenya, Uganda, Somalia, Zimbabwe, and Botswana as well. So dollar-based life insurance clearly is of interest to our clients and prospective clients right across Africa, which is no surprise to myself, and I know it won't be to yourself either. Just as a brief introduction, Richard's been in the industry for incredibly, I know he's nice and grey, but for 37 years now. He's been in private banking, he's been in international wealth advice, but most importantly, been in the realm of high net worth individual office, family office type wealth planning for the most of his career, whether that's been through banking or private institutions. And over the last 5 years, through Continental and CFS Geneva, being directly involved with the life insurance evolution that I've certainly seen over the last half a decade or so, specifically for places like Africa. I think when you talk life insurance in general, anybody with slight amount of grey in their beard or hair tends to switch off because life insurance is too easily associated with the very straightforward black and white and overpriced life insurances from the 80s and 90s, where our grandparents would go, yes, I paid for life insurance, I didn't die in time, and ultimately never got my money back. And it's been very interesting to watch companies like yourself, Richard, over the last 5 to 10 years, completely revolutionize how insurance policies can be used as a strategic wealth planning tool, vehicle that ultimately, as I love your saying, keeps the rich rich, which for a lot of our high net worth individual clients across Africa is terribly important. So Richard, personally, I'm looking forward to your presentation today. I will just tell the audience that we've had a bit of a nightmare with technology as we dialed in at about 10:30 this morning already to make sure everything was working. So there's a bit of a delay between myself and Richard, which means that we're not going to be talking to each other that often because it will be a bit broken. I'm going to hand over to Richard, and he's going to do his very, very best to keep us superbly entertained over the next 35 minutes as he goes through his presentation. So Richard, welcome again, and take it away from there.
Fred, thank you for your very, very warm welcome and lovely words. And yeah, it's always a great pleasure to support our friends at Carrick Wealth. We have a long-standing relationship and, more importantly, friendship, which is fantastic. And to everyone tuning in today, I thank you for sparing the time to do that as well and listen to me drone on about life insurance, which ultimately a lot of people would see as a very boring subject. But someone said to me the other day they liked me talking about life insurance because I injected some comedy into it. Well, I don't promise a stand-up today, but I'll try to keep it from anything from but boring. Life insurance ultimately is something that we don't particularly like doing or like participating in, but it is a necessary requirement of life. I look at life insurance as one word. It is a utility. It is very much like having water that runs to your bath, like the water that runs out of your toilet, like your electricity, like the tiles on your roof. It is a necessary obligation when you have obligations to have some sort of protection so you can look after those that are left behind. So as Fred said, it keeps rich people rich. And so I hope today you'll find some words of wisdom, and I hope some things will resonate with you. And as you know, you're in great hands with Carrick Wealth to look after you and do the respective follow-up. I won't bore you about my background. I think Fred's done that already, but suffice to say, my hair is very gray, but it's still there. So my father actually went white when he was 24, bless him. So what I'm looking to do today is help you dispel some of the myths about life insurance and some of the different types of life insurance, and also bring in other components such as the investment element, because these plans that we're going to be talking about today are functional. They can help you in a number of ways, not just participating in sort of paying out when someone passes away. Look, we're all going to go at one stage. No one knows when they're going to go, but no one gets out of this world alive. So this is a necessary part of life. And we'll talk about some of the myths about life insurance and some of the reasons why so many procrastinate. And along the way, if you'll allow me, I'll be giving you a few examples of cases that I've been experiencing firsthand where things have gone right and where things have gone wrong as well because people were procrastinating. But let's go back to basics. So let's talk about life insurance, not as life cover, but let's talk about it as risk management. And I say that because risk management is simply taking the responsibility of an accident or something happening away from your deep pockets to someone else who has got deeper pockets. And then you can carry on with life as normal. We don't think twice, generally speaking, about insuring our car. When we go on holiday, my daughter's over in Thailand just now, you must get your travel insurance. It's a necessity. We get travel insurance. We don't think twice about it. We insure our buildings, we insure our offices, our factories, so that when there is a fire, and fires happen, as you well know, first thing you go to the safe. Are we insured? Are we covered? Yes. Life can carry on as normal. We even insure our pets so that they can be looked after at the vet. Now, this wasn't me getting my car off the first time round, but when you buy a car, generally speaking, you just get the keys and the salesman says, before you go, I need to see your life insurance policy. So your car insurance policy, so that you're safe on the roads and legal. But when I took my daughter home in Dubai when she was born, or my son when he was born in Cape Town, it was, bye, here's a teddy bear. They didn't check if I had life insurance. And so many people slip through the net of not making proper provision for their life cover. And yet, here's a thing for you. 24th of February last year, on the BBC, there was a report that the average age for a man in America, his life expectancy has reduced by 1 year. By 1 year, that's massive. The average age of a man reducing by 1 year. And for certain sectors, it was more. Now, we've experienced COVID. You may have had COVID. I have. You may have had people that have been very ill, or worse still, who've died from it. One of my friends died from it. He was 1 month younger than me. It was unforgiving, unrelentless. It was indiscriminate, whether you were rich, poor, or whatever. It spread the world like something we've never seen in our lifetimes before. And yet, so many people haven't acknowledged that. But similarly, a lot have. A lot have looked at their mortality and reviewed, what would happen? What would happen if I wasn't here tomorrow? Market uncertainty. That will come in when we talk about the investment component of this multifunctional product I'm going to talk to you about, or concept. The war in Ukraine. Of course, they weren't going to invade. Of course, they were just doing exercise, and then all of a sudden, all hell let loose, and markets adjust accordingly. Do you know that Ukraine supplies 400 million mouths with grain in Africa? I didn't know that, but I'm learning these things. That creates uncertainty in the market, which creates differences in share prices and creates instability. Rising interest rates, unstable energy prices, increasing inflation. A block of butter in the UK costs £5 at the height. It's come down a wee bit, but at about £5. And now we're talking about what's going to go on in China and Taiwan, which has always been a bit of a hotspot. So despite all these things, people are still not taking action. And that's what you need to do if you are vulnerable or if you are worried about becoming uninsurable. And we'll talk about that later. And all the while, record numbers of businesses are going broke because of the impact on the previous slide in most cases. And so we want to try and insure against that in case someone passes away who is a major part of that business, so that, in the words of Freddie Mercury, the show must go on. The people must come to work, the people need to have jobs, the businesses need to be there, and we are ring fencing our businesses as well. Coming back to life insurance, there is a perception that it's boring because the money is lost. I'll do it later. I won't die tomorrow, so I'll do it later. I don't need life insurance, and we'll counteract all of these. I don't want to talk about passing away right now. I was in Nigeria just before the British lockdown, 23rd of March 2020. And I was speaking with some partners to some clients. And as soon as I mentioned the words life insurance, shut us down. And I said, what's that about? What on earth is that about? And my colleagues said to me, if you talk about it, they feel that you're inviting death into their homes. So very quickly, we had to reframe, rebadge. Here's the thing. Instead of life insurance, we position it as creating a bespoke succession planning solution that has multifunctional features. That sounds a bit more interesting than life insurance. And of course, the old nugget. I have death in service because I work at Deloitte or PwC. That's fine, great, brilliant. But what about when you leave PwC or Deloitte? What will happen when you really need life cover when you're 65 and going to retirement? You might be uninsurable. You might have developed by then a condition. And heaven forbid, in 2007 at Lehman Brothers in New York, people went to work on a nice sunny day and they came out with a cardboard box and without any life cover because they'd just lost their job as Lehman's went under. And they weren't alone. So if you remember one thing, this is it. It doesn't have to be like that. And I'm going to show you how. A client may say, I have enough money. Okay, great. Well done. I'm so pleased for you. Wouldn't it be nice to have an injection of a huge amount of money in the event of your death so that your wife, your husband, your kids, your family can carry on with you without you? I hope when I die, my wife will shed a tear or two and maybe throw a pretty lavish party. But the following week, I hope that she can actually get to grips and get on with her work and get on with her life and live in the house that we love and that we've worked so hard for. And the question I would ask someone if they haven't got life insurance, okay, so tomorrow you're gone. What should your wife sell? What should she sell to put bread on the table or to make sure that the salaries in the business can be paid? And similarly, that's often the case with a business being rich. So here are my very quick one-liners. Money is lost. In this case, the plan will grow in value. So it's not like car insurance where, oh, I didn't crash my car this year. We need more money for next year. Oh, okay, here it is. In this case, what you're doing is you're having an investment component and a protection component, meaning that you're covered in those danger years. Now, I would say those danger years are when you're younger, when your kids are running around digging up worms in the garden, biting your ankles, taking all your money to buy chocolate, whatever. those years are covered, because as soon as a plan is active or issued, a policy document is delivered to a client, they're covered. Just don't lose the policy document. Keep it in a safe place, etc. We know the score. But there is a growth element that is coming through, and we'll talk about that and the perceived dangers of that, which I will quash immediately. I'll do it later. Don't become vulnerable. I had a broker in the Middle East, actually. I could tell he asked me to do a joint meeting with his client, and I did the joint meeting, which was very nice. The client was very nice, but he was doing it on his phone, and I could tell people were coming in and out of his office, signing documents. Oh, bring this. I didn't have his attention. You know how it is. This is important stuff. An electrician, when he's putting your electricity in your house, he doesn't have his phone like that. He doesn't have a coffee here. He's focusing on the job in hand, which is to get the electricity sorted out. And this guy was procrastinating, and the meeting was useless, and he wanted another one. And then he went quiet, and I got a call. He's had a heart attack. Game over. We can't even entertain a life insurance policy now. He had a heart attack. He didn't die, but he's now possibly become uninsurable, and possibly if he was insured, it's going to cost him twice the price. So don't become uninsurable, because it's not necessary, and it doesn't have to be like that. Of course, then he wants to do it, and I said, we can't even talk to you for 6 months. It was a difficult one. Death in service, we've talked about that already. Great. I had death in service at Lloyd's Bank. I left Lloyd's Bank, my death in service finished, and I thankfully haven't died yet, but I don't have death in service from Lloyd's Bank. Point made, hopefully. And then I have enough money, the business is rich. Great, congratulations, you've made a great business. Why would you want that to fail in the event of your death? Surely you want it to carry on. So let's just look at the next slide. So put life insurance to one side, park that. We are creating a bespoke succession planning solution, which I said has multifunctional facets. We are repositioning the family or the company balance sheet so that life can continue. Remember Freddie Mercury. And we're allowing things to just carry on as normal. And we're going to talk about how do we do that. So the reality is, it doesn't have to be like car insurance where you lose all your money, or where you are reliant on the stock market performing and ouch, the stock market went down, so the insurance company wants more money. And I'm going to show you how that works. First of all, though, funnily enough, I was in Johannesburg, I think it was about 6 months ago, and I got onto the 12th slide before I actually talked about the insurance company. And this guy put his hand up and he said, Rich, who's my money with? And I thought, that's the best question ever. And now I bring that right to the front when I talk about these things about specific products. Today we're talking about concepts. But it's fair to say we deal with the biggest and the best. These aren't things that might happen or let's hope for the best, or it should be okay on the night. These are companies that have been in the business for well over 100 years, before your fathers were born, most probably. And as such, a guarantee is only as good as the person giving the guarantee. If I turn around and say, look, I guarantee all your money, it's irrelevant. It's just Richard Williams sitting in an office somewhere in the UK. But a multinational, multi-billion, Fortune 500 company, insurance company, they're the guys you want to put your money with. These guys are doing billions of business. The minimum level of cover we are able to set up for our high net worth individual clients around the world is $1 million. The largest we've done is $100 million. Just think about that. That's a lot of cover, and we can do that pretty much anywhere in the world. Whole of life. I have a critical illness plan which will pay out if I get a critical illness, but it finishes when I'm 65. I'm 56 this year. So it's kind of finishing when I need it most. Whereas in this case, it's a life plan, but it's a whole of life plan. So it can become a living investment as well as providing that protection element as well. The investment element, and I'll talk about that, how that's derived. The beauty is here. If you just remember one thing, it's this, it's 0.3 and 0.4. So just take these two things away with you. The investment element, the component, the part that's growing alongside the part that's protecting, is growing by tracking, and I'll explain why that's important, by tracking an index. And in this case, it's the S&P 500. Now, I could bore you big time on that one, but let me just say it was launched in 1923 as the composite index and became the S&P 500 in 1957, since when it's delivered around 9% a year. Here's the thing. In these plans, the upside is captured, but the downside is not. And what does that mean? It means that when a market goes up 8% in a year, you get 8% plus a bonus on top of that. And we'll talk about some numbers if we have time. But conversely, if the market goes down 8% in a year, you're not spending the next year trying to get your money back because it's got what's called a floor. It's protected. So I've just told you or shown you a way that negative volatility is being managed, meaning that your premiums are guaranteed. You won't get a knock on the door from the insurance company saying, sorry, we haven't performed very well. Can we have some more money, please? That cannot happen. So all the while, what I'm looking to do is create as much predictability in an uncertain world. And that's what these plans allows you to do. And as I mentioned, don't become uninsurable by procrastinating. And when's the best time to start an insurance plan? Yesterday. But hey, you've tuned in today, so you're halfway there. I set up my plan when I was 28. 28 because that's when I got married. That's when I got responsibilities. I had my daughter when I was 30, and my premium was tiny, and it still is, because it was based on my health and my wealth and my lifestyle at that point. It's taking a snapshot at that point in order to give a guarantee there. But we're here, we're talking. We got insurance for a chap who was 62 recently. Scary time for him, I'll tell you why. Because part of the process in establishing the health, wealth, and lifestyle of the client was to get a medical. He had, let's just say, an episode when he was having his medical, resulting in him having to go to an overnight stay. It was a heart thing. They discovered that he had a heart condition about which he knew zilch, nothing. And it was sorted. It wasn't a major thing, but it meant that it was a major thing being avoided. And all the while, we were able to insure him with a very minimal rating. I bumped into him in a cafe by sheer coincidence, and he came up to me and said, Rich, if I hadn't known about that condition, I might not be here today. It was a life-threatening condition that was a time bomb waiting to happen. Thank you. And it was one of the greatest days, and I still keep in touch with him from time to time. Really good guy. Those other questions we've already covered. So what would you have to be sold until to support your family? Could your business survive without you today? Probably not. So hopefully I've still got your attention. Let's talk about what's actually happening with your hard-earned money. Think of it as a bank account. You're putting money from a bank account A into a bank account B. Bank account B is your life insurance policy. It's called Universal Life. It's called Indexed Universal Life. Indexed because it's tracking an index. So what's happening is the premium is coming in from the left-hand side, and it's going into what we'll just call the bucket, which is the account value. And from there, the underlying cost of insurance is taken, often referred to as the mortality charge. And going back to the BBC article I mentioned earlier, with life expectancy coming down, mortality charges go up because the underwriters and the actuaries of these insurance companies, putting it bluntly, they don't care. They will be working on statistics. They won't be hiking out how much it's going to cost. They won't care. They'll come up with a price, and that is called the cost of insurance. And then on the right-hand side coming in is profit earnings. And that's what I was mentioning to you earlier about the performance by tracking the S&P, but protecting the downside. Hopefully that's all clear. So the beauty of this, again, another story if you'll allow it. I had a very embarrassing meeting. One of my first meetings when I was probably in my early 30s, and it was in East Africa. And I had a couple, I was in private banking with Lloyd's Bank then, seeing these, a beautiful couple came in to see me at my hotel, sat with them, she's pregnant, got a baby on the way. She was a local Kenyan lady, very, very nice lady. And he was a British guy from my neck of the woods. And they sat there and they said, we want to do a bank account. So we sorted that out. Want to do a savings plan. So we sorted that out, and over time, obviously. But we want to start family. It's on its way, and we want to protect. And so we set up a life insurance plan. When I got back to my office then in Dubai and liaised with my office then in the Isle of Man, you know what they said? We can insure him because he's a British expatriate, but not her because she's a local. How do you go back and tell someone that? So my point is, in this instance, that's irrelevant. And I hate that story, but because it leads into UL, universal life eligibility. It's based on where you live. It doesn't matter what race, color, or creed you are. It's based on, do you live in Nigeria? Okay, this is the code for Nigeria. Kenya, this is the code for Kenya. This is Tanzania. This is Swaziland. This is Ghana. And these are places that many companies from the Western world don't even visit. My first visit, I was going to put a picture of my shoulder there. My first visit to Kenya, 1993, when I tracked 2 cheetahs in the Nairobi National Game Park. I've been visiting Africa, and I've lived in Africa on and off for 30 years. So I have a reasonable understanding of what how life is there. But I love the fact that not only does it not only does it cover the country, but we are able to cover over 150 different countries, all starting at $1 million. It's dollar-based only, I'm afraid. But then the argument there is it's giving you a nice currency hedge and also a fallback position, because even I'm sitting here in the UK, the dollar is the stronger of the two by far. We saw Kwasi Kwarteng's recent mini budget, and the pound went down to 104 to the dollar. I mean, that was panic station for us in the UK, and it's settled now back up to the 120 plus now. In terms of funding these things, it's not monthly or quarterly or half yearly. It's annual premiums or single premium, and that's just the way it is. And I would say on balance, the majority of plans that we set up are annual premiums rather than single premiums. Sure, you'll have someone that says, "This out the way, I'm not getting any interest there, it's not so exciting just now, I'll put a lump sum in." Fine, put a lump sum in, forget about it. By and large, after 5 years, there's a break even, so that, in other words, the pot of money, which I'll show you some examples, is now bigger than what you put in, and you're still covered. And suddenly, car insurance mentality seems a long way away. The ages, we essentially as adults, we can go down to 18 if we need to. And then a smoker is more expensive to ensure than a non-smoker. You would expect that. But equally, a healthy non-smoker can save about 15% more than an average non-smoker, and so on with smokers. So we've got very favorable underwriting conditions with our insurance partners. And part of the team I work with within Continental to support Fred and his many officers around the region, we have a lot of experience to be able to get the best deal at the best price for our partners around the world. And another thing I love is the medicals can be done in country. So I already have established relationships with medicities. I would bet pretty much all of your countries, to everyone that's tuned in today. And as such, that means it's minimal inconvenience on your part to be able to get that done. Because as I mentioned, we analyze 3 things in the process: health, wealth, and lifestyle. Are you healthy? If you're not healthy, we want to know about it. Doesn't mean we don't insure you, but we just want to know about it. Are you wealthy? This is for high net worth individuals. This isn't a retail plan that you chuck out there on Twitter or LinkedIn or whatever. It's for high net worth individuals, ultra high net worth individuals, business owners, people within family offices. And as such, the last bit is lifestyle. They'll analyze your lifestyle. Do you lie on a beach in Mombasa, lie on a beach in Nice, Or do you go shell collecting on the cliffs of Patagonia? I'm being facetious, but essentially they just want to make sure, are you a good risk to them? Okay, let's just click the next slide. So let's look at a couple of examples. David Smith. So David Smith is a 45, I won't do death by PowerPoint, but he's a 45-year-old non-smoker living in East Africa, running his own business. And he's worried because he doesn't have necessary protection for his family or his business. He's scared of risk. He's seen his friends lose money during the COVID crisis and previous to that, during the meltdown, the subprime lending, and blah, 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 blah. You know about it all. But he's got a lot of money. So in this case, he decides to take a $1 million policy. So he takes out a $1 million policy, meaning that at any stage from now until his death, he will get, or his beneficiaries will get, the bigger of $1 million or the accumulated bucket. Remember the bucket? The bucket. And as such, he's good for $1 million, dead or alive. It doesn't have to be just dead. So he put $16,200, which isn't crazy money, $16,200 a year into a plan for 20 years. And as such, he will pay over the next 20 years, by the time he's 65 and retires, $324,000. And he's covered for the rest of his life. Now, at age 75, his policy value is $410,000. And I'm not using some crazy growth rate there. That assumes a growth rate of just over 6%. Remembering that since 1957, the S&P performance has been 9% plus. So we're looking at a very conservative growth rate to derive that premium. And that premium will come down by 10 or 15% if he gets a good medical. Or if he says, I'm really happy with $16,000, we can afford that. How much more life cover can we get? And it's probably going to be $1.1 million. So who says you can't put a price on good health? You just got another $100,000 for not smoking, for not excessively drinking, and for exercising. So now David can forget about that and look at it as a savings plan stroke protection plan. Again, car insurance seems a long, long time away. Let's look at example 2. Slightly different, and you can read it as I'm talking about it. But essentially here what we've got is a man age 50 with 2 sons, David and William, and also living in East Africa. David is involved in the business. William isn't. He's a musician. He doesn't care about manufacturing toilet rolls or bread or whatever it may be. He simply wants to know that he's going to be okay in the long run. But at the same time, David knows that his dad will die at some stage because no one gets out of this world alive. But he's worried, and his dad's worried, because when John dies, William is perfectly entitled to have his slice of the business, and it may crash the business. So as a result, what John does is take out a policy in his life for $2.5 million. And you can see there. And it's actually, instead of 20 years, it's 15 years. That's a typo that I was advised of this morning. So 15 years at $57,200 a year. It's a lot of money, but it's sorting out a big problem, and it's keeping an asset on the company balance sheet over time. And the growth after when the client when he's 75 is $1,033,382. So he's paid an $858, and it will grow to over $1 million when he's 75. So all he's doing, he's incorporated risk management into his business to A, protect his business and everyone that works there. B, protect David, his son, who works in the business. And perhaps more importantly, C, William, who doesn't care about the business. He's a musician, but he's still his son. And all the while, the money that has been put in has grown more than was put in. And I think it's a fantastic way to structure. Here's a line for you. The best insurance plan is the one that pays the most when you need it the most. I know someone who lost her husband. She had 2 insurance policies. I won't tell you who they're with, and I won't tell you where she lives. She had 2 insurance policies. One was in trust, and one wasn't. 3 years ago, he sadly died. He was younger than me, significantly younger than me. I'm not that old, but he was younger than me. And one was in trust and one wasn't. The one that was in trust paid out within about 30 days. The one that wasn't in trust hasn't paid out as of today. Now, if you are relying on that money, if you need that money, if that money is essential for your business to continue, you've got a problem, big problem. And no one else cares because they'll carry on with their lives because they haven't died, but you're stuck in a huge problem. So it doesn't have to be like that, and here's why. Because every plan that we set up has what's called a master trust. Very simple, doesn't cost anything, it's wording. You can make everything sound fantastic, it's just wording. Meaning that you appoint a primary or a secondary beneficiary. So for me, my lovely wife, Claire, is my primary beneficiary. So if I die, she gets it. My lovely kids, Esme and Matt, if we both die, they get it. Simple. And all that's happening, as you can see on the diagram, client is here, paying the money into the trust. It's all in-house within the insurance company, which then pays into the life insurance company. 2 policy documents are issued. One goes to the client and one goes to the trust company, so that if the client's house burns down, there's a copy, and they would just reach out and liaise with the insurance company via their advisor at that time, who would help them sort it out and get payment. There were lots of questions that came through previously, one of which was, how long does a claim take place and what is the process? My husband's died, my wife's died, here's my policy document. 30 days later, here's your check, here's your TT. No one has a check anymore, here's your TT. That capital injection at the time when everyone else is crying and mourning and thinking, what on earth do we do, will be very welcome, if only. How many people say if only? 2 key questions in this whole industry. Question 1, have you got life insurance? Question 2, did your husband have life insurance when he died? It hits home. I know people that have died without life insurance. I know someone that recently passed away and he was under 65. Again, he's just a little bit older than me. Very sad, long disease he had, and he passed away. But he had a life insurance policy, which would pay off the mortgage. And after he died, they went and checked out his financial affairs. And the bank, sure enough, had redone his mortgage and transferred it to someone else and blah, blah, blah. But they didn't transfer the life insurance. They didn't carry on paying the premiums. It lapsed without value, without cover, meaning that his mourning widow, I read video on my camera, his mourning widow had to go back to work to pay for the mortgage. Again, it doesn't have to be like that, does it? Hopefully that's convinced you of that one. So what next? What is required in order to think about setting up these plans? Do you procrastinate? Do you increase the cover you've got? Is your business bigger than it was when you took out your current insurance? Have you got more kids? Are you planning kids? Have you got grandchildren that need educating and it's going to cost a few quid? And by the way, as a pot grows, let's say we go back to our pot that was 800 grand. You could turn around and say, well, I could kind of do with some of that money because my grandchildren have gone to school. It's going to cost 100 grand. Fine. Take out 100 grand, leave in 700. That will carry on paying that drip into that little glass I showed you, the cost of insurance. And as such, it becomes a living plan that you can dip into and access. It doesn't require a death to pay out. You can actually access it. So these are the things I talk to my partners about. This is what we need. Name, please. The level of cover required. It's amazing how many people forget it. Can I have a quote, please? How much? They forget to say. So remember, it's $1 million later. I was talking to my boss the other day, who's 40 years in this industry, and I said to him, when is enough life insurance enough? And his answer was so quick. If the premium isn't hurting, you haven't got enough. And that's not just a salesman saying that, because over time, the premium will reduce by default. Why? Because it's fixed. So $10,000 today won't feel like $10,000 in 5 years because everything, income, salary, turnover, growth of the business will have increased. It'll come down by default, but it will still be $10,000. Date of birth, very quick, very obvious, because the quicker you start, the younger you start, the less it is. Gender. Women live longer than men. Fact. The country of residence. Where do you live? They'll be looking to see where the person spends most of their life. So, for example, if someone in their moment of enthusiasm went up to Dubai and bought a flat, but they live in East Africa, they don't have a Dubai. They have a Dubai visa residence, but they're not resident in Dubai. It's where the majority of the time is spent. And multiple passports. Are there any other passports? For example, Americans are very difficult to cover for, virtually impossible. But we had a client who was in West Africa, who had a West African passport, and we said, have you got any other passports? And he did. He had an American passport, which was very, because he was born there. But it was okay. We managed to get it through for him. But if you have someone living in Texas who wants to take out one of these things, it's not going to happen, unfortunately. They've got a very complicated tax system there. And then any existing preconditions. Yeah, I had a stent put in 2 years ago. I didn't, but they might have done. Or they might have hypertension, or they might have been treated for depression, or they might be diabetic. These are things that will come out in the medical. And what the insurance company wants to know is, A, you're aware of it, and they are aware of it, and B, are they getting it treated? You can manage all these things now. You can manage diabetes. You can manage so many different things now. So it doesn't mean you're going to be rejected. They just want to know. And then last but not least, again, one that everyone forgets, how are you going to pay for it? Someone might say regular premium. Okay, so 10, 15, 20 years or whole of life. I would urge you to think about the 15-year. 15 years is always quite good. And it's quite nice to get that pain of premiums out of the way, but know that cover's there for the rest of your life, but you've paid for it and no more money is ever required again. Let's look at my next slide, which I think I clicked on. There we go. Ashok Sadhana. He is an amazing man, and we have an incredible partnership with Carrick Wealth. But this man is self-made. He started in the business 40 years ago. He's a true friend of mine, and we have known each other now since 1996. My biggest joy is seeing our global partners successfully conclude world-class protection for their clients, securing the welfare of their families and in some cases their businesses. Our success is based on an unquestionable passion to deliver the best service and support available in the market today, which is why we are market leaders. This is what I believe makes Continental the best partner in the protection industry. And seriously, it's an honorable job, helping people sleep at night. That's it. So life insurance is a little bit boring, but it's necessary. And I think it's something that we can all look at favorably. Fred, over to you.
That was a wonderful presentation, Richard. Thank you very, very much. I think there's a few points which to me are really, really important. Not least of all is that Continental and Carrick, through our partnership, we are taking dollar life insurance where very few people have gone before. The feedback we get most often from clients is, are we allowed to do this from Nigeria, Tanzania, Ghana, Congo, Rwanda? Because so often people have been promised by European-based or international-based companies, but ultimately nothing came to fruition. It's truly unique to see high net worth individuals who are CEOs in their own right, financial directors in their own right, presidents of societies within their own right, that look of relief and sigh of relief to know that they finally actually have been able to access a world-class dollar insurance, which can mean true security to their wife and dependents or their business. So from my side on a corporate level, thank you for all the hard work you guys do in making this a possibility across Africa. I'll be the first to admit that due to Africa's grey listing or perception on the global scene, these policies are often a challenge to put in place. Our clients aren't very aware of that because a lot of the hustling, bustling, organizing, and scrambling is done by our and your back office to make these opportunities worthwhile and in place for our clients. I've got two questions for you that were sent through by our attendees as part of their registration process. I think the first is a slightly technical question, but perhaps you've already answered it. We've had looks like a lady from Tanzania specifically asking, how do I connect US dollar-based life insurance to my existing family trust?
So that's quite easy to answer because the policies can be written and held by a trust. So it'd be a case of just setting up so the individual would go through all the same checks, so health, wealth, lifestyle, and that would be what's called the initial submission. And then they would ascertain whether or not the insurance company was saying, hey, this is great. We can work with this person. We would love to offer risk. We'd love to offer a policy. And at that stage, we do the second submission, which is then the application process and the trust. So instead of the master trust that I showed you there, which is the simple, straightforward one, we would slot in the trust that your lady inquirer has mentioned. And we would need to ensure that full KYC, so know your customer reports are done on that. But these trusts are used to that. They generally have a pack, so listing any sort of associates or how it's done, just so that the insurance company is aware of the intricacies within that trust. But it's very easy. Take one out, slot another one in. It's like changing a spark plug.
Fantastic. Now, the lady didn't explain why she asked the question. If I can jump to a conclusion, it's perhaps trying to ensure that any payout, whether it's the savings payout or the investment linked payout or the unfortunate payout of after death, that in both of those cases, the payout itself can actually remain ex-Africa, so that the results of the insurance aren't necessarily then paid into Nigeria or into Tanzania or into Rwanda, and then ultimately get sucked into the very economic risks that our member tried to avoid by taking out a US dollar insurance in the first place. So she might have asked the question to try and solve that, but perhaps just a reminder from your side that with this type of insurance cover that we're looking at through Continental, that type of complex structuring isn't required in the first place because the benefits are already designed to pay out ex-Africa without the need to be contributed to the member's country.
Absolutely, yeah. This is an offshore plan. It's an out-of-country plan. Generally speaking, the insurance companies are Canadian-based, but they have their offshores, as in their non-North American and Canadian business, based out of Bermuda. And as long as the bank account details are supplied, the money can be paid pretty much anywhere.
Fantastic. And then a final question has just come through. Sorry, Richard. Sorry, go, Richard.
Yeah, one thing I would add there is, unlike a trust, a traditional trust, think of a trust as management from the grave. So someone's died and they say, I want Johnny to get $20,000 every year to make sure that his needs are met. And if he gets into drugs, then we'll just cut that back a bit, for example. Whereas a master trust is saying, death, payout, that's it. There's no sort of management or structure. So sometimes a trust is useful because it allows the detailed wishes of the deceased to be conveyed to the remaining parties of their family or their business, if that makes sense.
Yeah, absolutely. And then the final one, which really speaks to the very heart of what we believe as the advisory and wealth planning firm, and certainly I know you believe passionately as the provider, why, or the question is phrased specifically, how does dollar-based life insurance remain compatible with African risk and African business reality? I'll give that one to you, Richard.
Yeah. Do you know, when I was at Lloyds Bank, we were always advised not to give advice on two things, and it was almost the big no-no. One was forex advice, foreign exchange advice, currency advice, and the second was specific tax advice. That has to be dealt with by consultants. But I would comment that by and large, it is the US dollar is renowned as being the global currency that is the big one. Now we see over time huge changes in currencies. You know, for example, when I first went to South Africa, we had two rands then. We had the commercial and financial rand, which I think were then 5 and 7, and now it's about 22 to the pound. So it's changed massively. I would say that the fact that you have a dollar-based plan means that you are mitigating a significant amount of risk from a currency perspective for future generations. And in doing that, you could argue you're keeping them safer and creating some form of a fallback situation. How you do that on a day-to-day basis, no one can say what's going to happen in any African country, or any country for that matter, against the currency. But the long-term picture, as we've seen with the S&P 500, has been growth. The long-term picture with the US dollar has been stability. Now, for anyone that's looking to take a risk, there are other products to deal with that. But here, all we want to do is make sure that the show goes on and rich people stay rich. And by and large, high net worth individuals either have offshore accounts or have access to US dollars.
Yeah. Okay, second to last question then, because I do like the last one a lot. A quick question here. I take it this is hopefully a loving dependent, as in a loving child asking the next question, which as an advisor I always find interesting. Can I insure my parents' lives?
Great question. The answer to that is theoretically yes, but it would be so let's say Mr. Smith is the parent. So Mr. Smith can get insurance that would all be based on his health, his wealth, and his lifestyle. He would have to be a high net worth individual. However, it may be there is family wealth, so that could be factored in. So for example, working it back the other way, you could have someone who's younger who wants insurance, but he's not wealthy, but he stands to inherit a significant amount of money further down the line. And in that case, a letter from the accountant or the auditor confirming that he's one of two children. He's going to inherit $100 million, let's say. But going back to your question, so yes, it could be done, and ideally it should be done with the parents' money or from their bank account. But by and large, a premium can be paid by a blood relative.
Fantastic. And then the final one, which is a wonderful segue as we are about to say goodbye to all our listeners across Africa. This is from Jonathan in Nigeria, which in all fairness is just music to my ears. Message, or the question has come through. How do I put in place jumbo whole of life cover for myself and my business partner? So, Jonathan, you can very definitely expect a phone call from one of my advisors in Mauritius, who will very definitely be in contact with you over the next 24 hours. We've got your name and your number, so that conversation is going to take place. But ultimately, I think the emphasis is the following. That conversation with you, Jonathan, in Nigeria, with one of my advisors in Mauritius, will not only be how do we put in place the jumbo whole of life insurance you've requested, but more importantly, a wider discussion in how do the complexities of what Richard has presented today, how can we build that into your long-term wealth preservation strategy as an African high net worth individual? because that is what Carrick Wealth do across Africa best. So Richard, I would like to thank you very, very much for joining me today on this month's presentation. I'm very certain that we will be seeing more of you by the end of the year. And I'm also very certain that many of the people who've joined us here today, that once they've decided to continue the conversation, will have the opportunity to meet you on a one-to-one basis as well, to discuss their very specific situations, their very specific own needs and wants, and how your potential products or your products could potentially best suit their needs. So I'd like to thank all our listeners across Africa once again for taking the time to dial in this morning. I certainly am finding these very enjoyable. I know we've had a number of returnees today as listeners as well, which means that we're certainly touching the right chord with many people. Richard, I'm going to give the final word to yourself, sir. Thank you very much and goodbye.
Thank you so much, Fred. And it's always a pleasure to be invited to these events. What I also love seeing is that the number of attendees doesn't drop off, where sometimes they do when the material is quite mundane. It's so important. I go back to my earlier point. You should look at life cover as a utility. It's a moral responsibility. It's an obligation. It's something you need to do, because we all know someone who's passed away and not made a plan. But thankfully, most people that have passed away have made a plan. Be one of those people and reach out to Carrick Wealth. They are one of the best in advisory firms in the world that I've dealt with. They're friendly, and also they take it very, very seriously. So it's a core aspect of the financial planning process. Thank you, Fred, and thank you to Simone in the background for organizing today. It's a great pleasure and a real honor.
Thank you, everybody, and goodbye.
Bye-bye.